everybody. It's Honorable Minister, fellow delegates, it's a real pleasure to be here. I'm going to spend the next 15 minutes or so giving you a little bit of a perspective about the Asia-Pacific capital markets sector for hotels and hospitality. So the way I wanted to sort of split this up is to talk firstly about what's happening in the broader capital markets business, look at it in a global hotels context, and then distill it down into the Asia-Pacific region. So if we start with investment activity in commercial real estate overall, basically total transactions volume in all of commercial real estate peaked in 2021 at $1.3 trillion. Now, since then, of course, with the rate hikes that we've seen, a lot of that momentum has been taken off, and currently we're about half the overall liquidity that we had at the peak of the market. There are, of course, nuances in that. Historically, the Americas has always been the most active commercial real estate market. It still is, but volumes in the Americas are significantly down. And where we're sitting at the moment in year-to-date 2024 versus the same period last year is that in terms of volumes, we're largely flat, but with some differences. So you've got Asia-Pacific that's powering ahead, whereas America's down by 10%. Now, if we then look at that in terms of sectoral, very much the theme is hospitality and living. So if you look at the volume increases year on year, you can see that in markets like Japan, China, in Korea, in Singapore, the volume of hotel transactions are significantly outpacing the volume of transactions that we're seeing in other sectors, which is obviously great for our industry. And what's really driving that is, of course, is that hospitality is an inflation hedge in the sort of environment that we're in. And we're being powered by the continued momentum that we're seeing post-COVID in tourism demand and recovery. If we then look at it sectorally in terms of what Asia-Pacific volumes represent for the various sectors, you can see that hospitality is increasingly a larger volume of an overall portfolio allocation for investors. In the last quarter of 2024 in Q2, which is the latest data that we have, 14% of all investments in APAC was in the hospitality sector, which has been one of the highest. Historically, it's been less than 10%. We're now going into the upwards of 10%. And then, of course, layer that with living as well. So this is co-living, multifamily, student accommodation, anything with a bed on it. There's an increasing focus on adjacencies for hospitality real estate, and investors are diversifying away from hotels into other alternative accommodation sectors. What's, of course, driving that is the rate cycle that we're in. So I think we're all very pleased to say that we're now basically at the peak of the rate increases. We're now going into a period where we're expecting and already seeing rate decreases. As you can see on the top there, you'll see the rate change in all of the key markets since the hikes began, and then where we're seeing in which markets the declines, with the exception of Japan, and of course China is a bit of a misnomer. Majority of the markets are now seeing rate declines, which is great from an investment perspective because as buyers, we can now see a bit more of a sort of a light at the end of the tunnel. The pricing discovery is a lot more easier, and investors have a bit more visibility in terms of how they can underwrite the exit cycles. Of course, India there, highest in terms of the kind of the base rate relative to its peers, but I'll talk about what that means for investment returns in a short while. Now, thematically in real estate, here are sort of some of the kind of key focus areas. I would say that there are plenty of buyers out there. There's been a lot of high net worth investors that have kind of been waiting on the sidelines on cash reserves, and they're looking to invest in hotel real estate. In Singapore alone, there are more than 1,000 family offices that have been set up, and those guys are very much looking at hospitality as a diversification strategy. More than ever, geopolitics is becoming a focus. So I can tell you that Chinese investors are no longer investing in the US, given what's happening there. Of course, we've seen, in the last, earlier in the year, there was, what happened with the Maldives and some of the negative PR that generated. So those sort of influences are coming to how investors are shaping their allocation strategies. For instance, a lot of Chinese investment now is going into the UAE because there's friendly relations at the G2G level. We are seeing that there are sectoral preferences that are coming up. So investors are becoming razor sharp in terms of what they want to focus on. Previously, it used to be global real estate. Now it's like, well, I want to be investing in India, or I want to be investing in the resort sector in Southeast Asia. So, and that's what the LPs are demanding, and that's what the GPs are trying to provide for increasingly. I would say that there is still that pricing discovery because, the rates are moving. So there is, in some markets, a bit of a bid-ask spread. We're in a bit of a stalemate. In other markets, liquidity is a lot more readily available. But again, nuances. Importantly, domestic capital is the most active, and I'll show you some statistics around that in a minute. And private wealth and private investment is going to be driving a lot of that activity. And as I said, these new sectors. Now, when I began my career a very, very long time ago, hospitality was alternative. I think hospitality now is core to any investor's diversified portfolio strategy. What is alternative is multi-housing, built to rent. It's co-living. And again, buyers are going into those sectors as well. Now, what that means for global activity is that globally in the first half of this year, there have been about $27.5 billion of hotel real estate investments. In terms of actual number of sales, we're down about 20% to 622 transactions. But what that actually means is there are higher value transactions that are taking place because the price per key on average for a hotel sale has increased. And what I like the most in this statistic is that 23% of all activity is cross-border. Buyers are agnostic about where they place their money. And again, that's where I feel the India opportunity really then comes to the fore. If we look at demand fundamentals, and I won't touch on this too much, but obviously domestic demand, domestic capacity is leading the way. But in terms of international capacity and demand, air capacity, we're still below the 2019 peaks. And that's obviously having an influence on how we're seeing some of that recovery shape out at the moment. Now, everyone keeps asking me, where are the mainland Chinese? Are they coming? Well, they are, and you can see in certain markets like the Maldives, they've only almost recovered back to their pre-COVID peaks. And in other parts of the world or region, key markets that they would be coming into, they're at sort of 60 to 70%. So we need, globally, we need the mainland Chinese to be traveling to get back up to the, to bring the occupancy levels back up to their pre-COVID peak. But the really interesting story is India. So if you look at this chart, I know it's a little bit complicated, but basically outbound Indian tourism between 2014 and 2019 outpaced China at around 8% compounded growth. At 2022, which is the latest statistics that we have, Indian outbound tourism has recovered to 80% of the peak, and the Indian traveler volume at 26 million is higher than China. So forget about China, it's all about the Indian outbound tourism potential. And obviously, that creates a lot of opportunities for the Indian brands that are looking to expand into international gateway markets. Now, if we then contextualize it into the state of the recovery, what we've done here is we've compared essentially occupancy and ADR in the region relative to its recovery to the 2019 peak. So you can see Asia Pacific overall, so essentially we're looking at RevPAR here. Asia Pacific overall is still below the 2019 peak. But again, there are a lot of nuances. Now, if you distill it again, if you look at India in terms of rate, as at year-to-date September 2024, relative to the previous peak, Indian ADR is at basically on par in terms of where it is relative to the recovery to Japan. Of course, there's a bit of currency play here that's diluting this. But again, we're powering ahead on rates, but it's now more about occupancy and bringing occupancy to the right hand of that line. Only a few markets are exceeding his pre-COVID occupancy levels, but certainly it's a very positive story to see basically the entire region overall has outperformed in terms of ADR relative to its pre-COVID peaks. China, of course, still going through quite a lot of challenges. If we then sort of look at that again in the context of what we're seeing, what it means for ADR and occupancy, I think the general theme for the region is kind of ADR starting to stabilize in majority of the markets. I think we're still seeing overall more growth in India, and then occupancy levels rising. We need air travel to become more affordable in order for occupancy levels to rise back up to pre-COVID levels, and we need, again, kind of MICE activities like this to really return back to the forefront. And there is, I think, a positive momentum there. What's good for future growth in trading is that the supply environment is relatively benign as well. In the next 12 months in India, roughly 2.8% supply growth, and that's kind of on par with the APAC average, Vietnam being the only exception where we've got double-digit growth in supply. So what does that all mean in terms of Asia-Pacific investment activity? Where we're standing today, in APAC, there were $9 billion worth of investments in the hospitality sector. It's about a 22, 24, 23% growth year on year. The average price per key, $272,000 per room. Again, roughly, I would say, on par with 2023 numbers. The real nuance is very much in the difference between Asia and Australia. Australia is a market that's really going through quite a tough period where fund managers acquired hotels just before the pre-COVID peak at pretty high valuations. We've now seen a real price disparity appeal, and I call it the Mexican standoff. And so we've seen volumes decline quite significantly, and price per key as a metric fall as well, as more mid-market sales happen, not enough big-ticket sales. Now, what's kind of leading this recovery? I touched on the interest rate environment. So in this graph, basically we're looking at the positive spread between your cash-on-cash return with buying a hotel versus the cost of servicing the loan. So whether it's a positive yield or is a negative yield. Now, if I was showing this graph 12 months ago, everything, with the exception of Japan, would have been on the left-hand side. Now, increasingly, we're getting creep onto the right-hand side of the graph. Of course, Japan, as you can see, is kind of the highest spread relative because of the very, very low cost of borrowing environment. If I just distill that into a little bit more detail, in Japan, you can buy a hotel at 3.5% yield, which is ridiculously low, I know, but you're borrowing at 1%, maybe even less than 1%. So that's where the real dynamic is. Now, the good news is, based on some of the more recent trading activity that my team here in India have been working on, we are seeing a small, marginal positive spread in Indian transactions. And please speak to Jaideep, Harmeet, and the team about that during the conference, about what they're seeing specifically as it relates to here. But again, Thailand, positive, Japan, positive, and then Southeast Asia, selectively positive. But then Australia, Singapore, we're in the negative territory. So what it means for buyers is they're not buying core plus opportunities. They're looking at opportunistic investments and value add. So they're not buying for cash flow. They're buying for reversionary value on exit by buying something to rebrand, reposition, refurbish, and then exit. And talking of exits and the type of investors we're seeing, 21% of all activity is basically private equity. So this is the playbook of private equity investors. Buy, renovate, refurbish, rebrand, sell. 4 to 7, typically 4 to 7 year holds. 19% corporates, 9% developers, and then 7% high net worths. Now, they, in my mind, I think are one and the same, because a lot of the Asian investments in our region is high net worth in nature. You might be a corporate, but behind that corporate is a high net worth investor, similar with a developer. So still very strong high net worth activity, and as you can see, slightly more cross-border investment as we go into 2024. What's interesting for catalyst for more activity next year is that on the right-hand side, you'll see there's about $10 billion worth of real estate that's held within closed-end funds that are now coming to the end of their life cycles. These funds have to exit out of these investments in the next 4 to 5 years. So there is going to be this activity that we will see across APAC because of the nature of the fund vehicles and the investors that need to exit out of these investments. On the left-hand side, there's not been a lot of new funds that have been raised for hotel investment, although if you kind of take that back a couple of more years, again, you'll see variation. At the global level, there is private equity funds and funds that's been raised that's available to invest, and as I said, more high net worth in our region anyway. So in conclusion, what you see here is kind of our views on what's going to happen this year. We're expecting $12 billion of sales for the full year. It's about 5% year-on-year growth. We're expecting a bit more growth next year. And the markets that we're very much focusing on in terms of markets to watch are Japan. It's Japan because of all the right things. You know, it's the currency play. It's that spread that I talked to you about. It's the growth in the inbound tourism. The Maldives is very different. It's a global gateway destination. It attracts a lot of investors. It's got high yield, high return, and it's in US dollar denominated. It's largely a US dollar denominated business. So it takes kind of currency risk out of the way. Shanghai, because there's distress. China has a lot of distress. Property developers are looking to clean up their balance sheets, and that's creating liquidity, but a lot of that liquidity is trapped in China. Singapore, because it's a safe haven, it's where you park your money for the long term. It's for wealth generation. It's for wealth preservation. And then lastly, Brisbane, because of the Olympics and the impact that the Olympics will have. But what I would really like is that the next time that I'm up here with you guys is to be able to showcase India as one of the top 5 markets to watch for 2025. Thank you very much.